So talk to Kevin Plank and his number 2, Patrick Frisk. It's important because Frisk is in there to sort of right-size the business and get it to a maturity point, which that's what the company has been blaming on some of its struggles when it slowed down from rapid growth over the last few years. So the headlines from this quarter, what they were trying to emphasize is that they've got a sustainable and more profitable business in place. And they gave them the same message that they did at their investor day, which is they're going to continue with the discipline and the cleaner inventories, which is a key highlight of the report today, down 12% from a year ago. That's going to lead to better profitable growth, which is what they're seeing. The missing component there, Kelly, though, is on sales growth. It was weak in North America, which was expected. It was weak on footwear, and international continues to grow double digits, but not quite the same level that it was growing before. So the onus is on the company now to prove that in its new mature phase with repeatable, sustainable growth, it can actually get growing again and get the brand wanted again. And it talked about a number of innovations like Hover to try to do so.
So Under Armour, Erinn, is at $22 today. You think it can get up to $30. How does it do that without the exciting revenue growth and growth overall that Sara's talking about?
Yeah, so we think there is exciting revenue growth to come. I think if you look at the way that the guidance for the year is paced out, Q1 is really the low water mark. So I would be a buyer here because I think as we go throughout the year, some of those innovations, Sara just touched on them. Hover, a great example of a franchise they are building as a multi-year kind of lever. Some of the innovations they have in the base layer for apparel, in women's, those are still to come. So as we exit 2019, our view is this is going to be an accelerating revenue story, not just a profitability turnaround story, and it's the best is still yet to come.
Where does the stock go, Erinn?
So our view is it should be closer to a $30 stock over time. And I think the initial pushback is, well, quote, it's an expensive stock on earnings. That being said, we view this as not a normalized earnings base for the company. You're looking at a business that today is doing a 3% EBIT margin. You look at their global peers, which we do think this is a company that has the levers to get there. And those peers are at 12, 13% EBIT. So you've got to look out over a multi-year basis. Even getting to their 2023 targets, it would put the stock, or excuse me, the earnings per share much closer to $1.20. We think that's conservative. So kind of looking at a DCF is the way we've thought is the best to approach it.